What's up everyone, it's Ben here from rareliquid, and today we're going to be going over an LBO tutorial, which is something a lot of you guys have been requesting. Going into today's agenda real quick, first I'm going to be going over what an LBO is at a high level. Then I'm going to be going over the 5 steps of how to build an LBO, and we're going to be jumping from this PowerPoint to an Excel model which you can download for free down in the description below. And so it'll be a lot of theory meets practice. And by the end of this video, you should be able to build out your own LBO video. And I'll leave a link to the model down in the description below. You can download it for free. And then at the very end, I'm going to just go over some advanced topics that we don't cover in today's video. So first up, what is an LBO? So the more fancy interview answer is that an LBO is a valuation methodology that ultimately measures the internal rate of return, or IRR, from purchasing a company, funded with cash, which is also known as sponsor equity, and a significant amount of debt. A PE firm usually aims to improve the operational efficiency of the company to generate cash flow that will ultimately pay down the debt that was taken on over time to increase the firm's equity ownership in the company, which is ultimately sold after 5 years. So that's a more fancy answer, but a more simple answer is that an LBO is like being a house flipper. At the start, you put down a small down payment, which is like the sponsor equity, and fund the rest with a mortgage, which is like the debt you take on as a PE firm. You then fix up the house, which is similar to improving the operational efficiency of the company. And you pay down the mortgage over time with your personal income, similar to cash flow, which increases your equity ownership, and you hope that the house appreciates over time so you can sell it and earn high returns on your investment in the house. Now, if you're looking at all this and wondering what the heck all of this means, don't worry, I promise by the end of this video, all of this is going to make sense. And before jumping into the 5 steps of how to build an LBO, I wanted to let you guys know about a newly announced Wall Street Prep plus Wharton Private Equity Certificate program. And this is a pretty unique collaboration where theory meets practical application. And a lot of the top clients of Wall Street Prep includes Bain Capital, BlackRock, Blackstone, Carlyle Group, and more. And so throughout this online course of 8 weeks, you're expected to put in about 6 to 8 hours per week. Everything is self-paced, so you can learn at your own time. And by the end of it, you'll get a certificate issued by Wall Street Prep and Wharton Online. And so you can put that on your resume and also on your LinkedIn. And the speakers and panelists are really from a lot of the top PE firms in the world. 2 that I'd really just point out here are Martin Brand, who is the head of North America private equity at Blackstone, and then David Rubenstein, who is the co-founder and co-chairman of Carlyle. And so what exactly will you get from this course? I've pasted all of the topics here, but just to go over them briefly: intro to private equity, the private equity deal process, deeper dive into valuation analysis and LBO modeling, and then how to think like a private equity investor. So you really get everything you need in terms of how to think like a private equity investor. And if you use my code rareliquid, you'll get $500 off if you sign up by April 1st of this year, or $300 afterwards. So if you're interested in any of this, feel free to check them out down in my description below. Okay, with that said, let's jump into the 5 steps of building out an LBO. And so here's an overview. First, you have to gather your transaction assumptions, then build out your sources and uses tables, calculate your levered free cash flow, then create your debt schedule, and then ultimately calculate your exit value and then your IRR. So starting off, step 1 involves gathering your transaction assumptions. And I've listed the more basic ones here. There are a lot more that I've not included because this is more of a beginner's tutorial. But going through these, first off is the entry price, which is the total amount a company is bought for. Then there are fees and expenses, which are things like legal, accounting, and bank fees for the various third parties that PE firms have to hire and work with. Then you want your debt, which are your different tranches of debt, basically the types of debt you have with the various interest rates. And then operating assumptions, which are things like revenue growth, margins, cash flow items, etc. The exit price, which is the total amount a company is sold for. Basically here, you're trying to figure out what multiple you'll use in order to exit the company. And then financials, which are things like historical income statement and cash flow figures. And gathering all of these assumptions, making sure that they're really, really accurate, is usually in the job one of the most, if not the most time-consuming parts of building out an LBO. And now let's jump into the Excel to, really crystallize what all this looks like. So I've gathered here in this first section a lot of the key transaction assumptions that we're going to use. And we're actually going to build out a little bit here to start building out the model. So as you can see, there's the entry assumptions, exit, financials, operating assumptions, capital structure, basically your debt assumptions. And for reference, later when we calculate our IRR, this will populate, but right now it's at 0. So starting off with your last 12 months EBITDA, we're just going to link this to our EBITDA here. And then our EBITDA multiple, when we multiply these two together, that's going to get us our enterprise value, which is basically what we're paying as a PE shop in order to purchase this company. So next here, enterprise value minus your net debt is your equity value. And so we basically have now here all the assumptions that we really need. And this will all make a little bit more sense as to the difference between enterprise value and equity value, why we need to calculate all this as we build out our sources and uses. A few additional notes I want to add is that a lot of times as a simplifying assumption, when you build out an LBO model, you'll just assume that your EBITDA multiple at your exit is the same as your entry multiple. And then a few other things here, your capital structure for your debt, you can see that 4 times, basically what this is saying is 4 times EBITDA or 2 times EBITDA. And then your cost is your interest rate, so 6% versus 12%. And obviously, as a PE shop or any company really, you want to take on as much debt as you can at lower interest rates. Let's next move on to step 2, which is creating your sources and uses table. And sources are the capital required to fund the deal. So think back to our house flipping analogy. This is basically for new debt, your mortgage, and then sponsor equity, your down payment. And just a quick note about your new debt. PE firms usually refinance debt with better interest rates because they do so many LBOs and take on so much debt that they have really good negotiating abilities with banks in order to afford better interest rates. And then uses are the capital required to purchase the company. So these are things like fees and expenses, retiring existing debt if the company has had any debt and the PE shop needs to refinance any of that debt. And then equity payment. So this is the amount PE firms will pay to existing shareholders. One really important thing you need to remember about sources and uses is that they always must equal each other. And let's jump into the Excel so you understand what this means. So as you can see here, we have our sources and uses section. And briefly going into these 3 columns, first off is the actual amount for everything. Next is the multiple of EBITDA, and then percent capital, which is basically for each of these, what percentage of your total capital you're using are each of these line items. So we're going to actually start off with this second column, this multiple of EBITDA. As you can see up here, we have our assumption 4 times for bank debt and then 2 times for senior notes. And the way we're going to calculate everything for bank debt and senior notes is to multiply our multiple to our last 12 months EBITDA. And I'm going to press F4 here so that we can just copy paste this down. And then if we add these two together, that's just our total debt. We can also just add these 2 multiples together to get basically what it is times our last 12 months EBITDA. Or another thing you can do is divide the total amount of debt by our last 12 months EBITDA, and you should get the same thing. So we're going to leave sponsor equity and total sources, all of this blank. We're going to go to our uses first. So for this part, we actually already have these assumption amounts, right? So our total net debt is 500 here. And then our equity payment is what we need to pay our equity holders in order to purchase the company. And here we're going to basically work backwards where we're getting the total amount and then we divide by our EBITDA. Then if we press F4 again, then we'll have the times EBITDA. And so the only thing really left here is our fees and expenses. And then we can copy paste this again. And so now we have the total amount we're using, right? So if we do debt retirement plus equity payment plus fees and expenses, these are the total uses that we're going to be spending. And then here again, we can either add all these together or divide our 2,550 by our EBITDA, but this should all kind of, yeah, this should all basically be the same. And one way to check it is that our total sources equal our total uses, right? So what we do here, we're basically backing into what the sponsor equity is going to be. And so the way to do this is you always just you press equals and then you go to your total uses, make these equal to each other so that they're never different. One way to check if our 10.2 is correct is we get our total sources and then we divide by our last 12 months EBITDA. And this is 10.2 as well. So then what we do to get our sponsor equity and how much cash our PE shop needs to put in is simply go to total usage sources and then subtract out your total debt. And this is how much cash the PE shop will need to put up. So next, let's just get our sponsor equity divided by our EBITDA, 4.2. And then the only thing left is percent capital. And this is really just for reference to see how much of each of these line items are contributing to the total amount of the deal. So what we want to do here is get the amount and then divide by our total sources on this section, or on the right hand side uses. I'm going to press F4 in order to not have to go back and forth or continually go back to that same cell. It's called anchoring. And I'm going to press Alt ESF in order to just copy paste the formulas down. And this should always equal 100%, right? Everything that you're funding the deal with should eventually be 100%, and everything you're using to fund the deal should also be 100% eventually. %. Okay, so that covers our sources and uses. And let's now move on to step 3. The next step involves projecting out your financials and ultimately calculating your levered free cash flow. And the formula for your levered free cash flow is your net income plus your depreciation and amortization minus your capital expenditures minus your change in net working capital, and then minus your mandatory debt repayments, which we're not going to actually include in this model, but I wanted to give you guys the full formula. And this gets you to your levered free cash flow, which is ultimately used in our next step, which is going to be to pay down debt. And so let's jump back into our Excel to see what all this looks like. I zoomed out of our Excel a little bit because this section is a little bit longer. Hopefully you guys can see everything. And I've also hidden our sources and uses rows in order for us to more quickly be able to get to our assumptions. So for revenue here, we're just going to link to our LTM revenue. And then for our future years, what we're going to need to do is just grow it by the assumption that we have here. And I'm going to press F4 in order to lock it. And then we can just make these just equal to the previous years because we're just simply assuming that the company is growing at a 7% growth rate each year. Then we're going to get our previous year multiplied by 1 plus our growth rate. And then this will get us our revenue. Next is EBITDA. Very similar thing. Just go to our EBITDA and then see what our margin is here. And we have this assumption here where we have year-over-year margin expansion. So we're not going to keep this flat. We're actually going to assume that the company is able to make, or the PE shop is able to make the company more efficient. And that's why these margins are expanding over time. And then so we just get our EBITDA multiplied by our sales, and this gets us our projections. Next for EBIT, we're going to need to subtract out our DNA. And I'm going to keep this here and just do this a little bit later. For interest, this is one of the more tricky parts of the LBO overall. You actually add this interest section towards the very end of the model. And as we go through everything, you'll kind of understand why, but we'll skip that for now. Actually, I realized we should first go to our cash flow items, and then we can like fill out everything else. So our DNA, if we link up here, you'll see that our DNA is here. And we're just using a simple percentage of sales. And so we can just copy this year 0 amount, and we're just going to use the same margin. Then for net working capital, we're also going to do a similar thing. We're going to see it as a percentage of sales. So we're linking up to the 100 here, dividing this by our sales. Then just going to make this the same as well and multiply this by our revenue. And as we discussed, we need to get our change in working capital, right? So that's our current year minus our previous year. And then we have our capital expenditures. So linking again up to our assumption for capital expenditures. And then divide by our sales. Again, we're just going to keep things really simple and just multiply or use it or project out our capital expenditures as a percentage of sales. And keep it flat, I mean. So we have our cash flow items. Now, what we can do here for our EBIT is get our EBITDA and subtract out our D&A. So that's our margin here. We can calculate this as a percentage of our sales to get our EBIT margin. And actually, we have to just do the same thing for our EBITDA here as well, because we projected these out. So what we're going to do is just get our EBITDA minus our D&A. And then since this is a formula, we can just copy paste this across. Then we have our earnings before taxes. So this we're just going to set up for now. It's actually going to be the same thing as our EBIT since our interest is 0. So we're going to get our EBIT minus our interest and have this as a percentage of sales. Actually, we don't even need this for year 0. So we're going to skip that because we don't have interest figures for our year 0. So earnings before taxes, that's simply our EBIT minus our interest. And then we also want to set up the margin as well. So that's our earnings before taxes divided by our revenue. Then we can copy paste this across. Taxes, we have our tax rate here, which is 21%. And then we can make this all just equal to previous year because we're going to keep it flat. And then earnings before taxes times our tax rate. Copy paste that across. That ultimately brings us to our net income, which is our earnings before taxes minus our taxes. So then let's divide our net income by our revenue to get our profit margin. And so that's us getting to our net income. Now, if you're wondering, how do I know that we just keep things flat or increase, it's just because I built this model and I know what assumptions I wanted to be using for this tutorial. When it comes to actually building all of this out, you're going to have to do a lot of research into figuring out how much your company should be growing out each year, what margins you could potentially grow things to, or if it's even going to decrease, which might mean you're not even interested in purchasing the company if your margins are actually decreasing. And then, so all of these, normally you're going to have to do a lot of research in order to make sure you have the right assumptions. For me, I'm just keeping things very simple so you can just see how an LBO works. The last step here is just to link to everything to calculate your levered free cash flow, which, as a friendly reminder, again, does not include mandatory debt repayments for this model. So we're going to link to our net income, then to our D&A, then to our capital expenditures, and then our change in net working capital. Then we do net income plus D&A minus CapEx minus change in net working capital as we discussed in the PowerPoint, and then just multiply this across. Or I multiplied our formulas using Alt-ESF for PCs. Macs, it won't work. And now we've projected out our levered free cash flow. The next step involves creating your debt schedule. And what is a debt schedule? Because LBOs require so much debt to fund acquisitions, it's really important to know how much debt can be paid off with your company's cash flow. And so this debt schedule or debt waterfall calculates your annual interest and principal payments. So in the actual model, which you'll see soon, the debt schedule structure for each tranche of debt starts with your beginning balance. Then you calculate your interest, how much you pay down of your balance of your debt. And then you subtract out from your beginning balance your pay down to get to your ending balance. And think of this just as if we think back to our house flipping analogy, how much you're paying down your house mortgage each year, and then what interest you need to pay for that mortgage. And as debt is paid down, your interest expense will decrease over time on the income statement and for all your debt tranches where you're paying down your debt, which you'll see pretty soon. But one thing I really want to quickly go over that is a little bit tricky when you're modeling for your debt schedule is what we're going to go through right now. So let's assume that you have one tranche of debt. Your first tranche is $1,000, and then you have levered free cash flow of $50. So when we are going into our model, we're going to be using a minimum formula. And for this one, for tranche one debt paydown, what we want is either the minimum of your levered free cash flow or the beginning tranche one debt balance, right? And so it's going to take the minimum of $50 or $1,000. And so this will produce 50. And the reason we don't want $1,000 is obviously we only have 50 to pay off. So let's see now what happens with tranche 2 for your debt paydown. So the next thing we're going to want to do is get the minimum of either your levered free cash flow for that year or the levered free cash flow minus your tranche one debt paydown. So this will bring out either the minimum of $50, which is your levered free cash flow, or your levered free cash flow 50 minus what you've already paid down, which is $50, right? So this, since it equals 0, the minimum of 50 and 0 is 0. So this will produce $0. And so this is why it's a waterfall, because you first pay down your first tranche of debt, which is usually the one that has the higher interest rate. And then with that remaining cash flow that you might have, you're going to pay down your second tranche, right? But a lot of times for the first few years, you'll be massively or aggressively paying down your more expensive debt principal payments. And then with the remaining cash flow, you're going to be paying down your additional tranches of debt, right? So I know this probably, if you're first seeing this, might be confusing, but let's jump back into the Excel model so you can understand what this means. So now I've hidden our financials tab in order to just make sure you guys can see everything, because we're going to be really going to our sources and uses and our levered free cash flow. So now we're creating our debt schedule. So what we want to do here is get our ending balance, which is at the end of year 0, what is our debt balance for our bank debt, which is the 100 here. And then we're going to link to our previous year's ending balance, because that's your beginning balance of the year. So your interest here is just your beginning balance multiplied by your cost, which is the 6% here. And I'm going to press F4 again in order to make sure that it's anchored. And then debt pay down. So this is the minimum thing that I was mentioning earlier. So we want to do equals min. And it's either going to be your levered free cash flow or your beginning balance. And that's 144. So your ending balance here is your beginning balance minus your debt pay down. And we're not including our interest. I'll show you guys how we're going to use this a little bit later. But that's the formula we want to use. And we can just copy paste this across. And that'll get us to how much we're paying down our debt each year with our free cash flow, and then the amount of interest for each. So the next thing we want to do is do the same thing for our next tranche of debt. So let's go to our senior notes here. And then beginning balance is your ending balance of the previous year. Interest is your beginning balance multiplied by your senior notes. And let me actually point out, this is a simplifying assumption, because the interest you're paying is actually usually based on the amount of interest you're paying each month, or maybe each quarter, depending on the terms with the bank. But for our purposes, we're just going to assume that the interest is based on the beginning balance for the full year. Now, pay down here is what I mentioned earlier. So min, either your levered free cash flow or your levered free cash flow minus the amount of pay down. So because right now we're using all of our free cash flow in order to pay down the first tranche of debt, this is 0. And what we want to do here is the same thing, beginning balance minus your pay down, and then multiply this across. And you can see that because we're still continually, paying down our debt, we don't have any free cash flow to pay down our second tranche, and that's totally fine. But imagine if our free cash flow here was like 500, then you can see here that we pay down the existing amount of debt that we have, and then we only then do we pay down our second tranche of debt. So that's why it's known as a waterfall, because you're starting from the top and paying down as much as you can for your first tranche, then your second, then your third, if you have a third, then fourth, fifth, and etc. So now here we have our total debt, which is our ending balance. For both of these, you just basically just add everything up. And we can actually, since we're just adding everything up, just press Alt ESF for our formula, and this will get us to our total debt in terms of beginning balance, the interest we're paying, the pay down, and the ending balance. And now this is where, since we have our interest, we can actually link it back up to our financials to see how much interest we actually are paying. And this is actually also going to lower our free cash flow. So let's just link down here to our interest. Copy paste this across. And you can see that it might not really be intuitive, but because you might think you need to have everything projected out here first. But as you can see, we can only really figure out how much interest expense we're going to be paying if we first create our debt schedule. So that's why we leave this blank. When we add these, you can see that our cash flow also decreases over time. And that affects how much you can actually pay down to your debt. And that is pretty much the debt schedule or debt waterfall. So the last step is to calculate your exit value and IRR. And there are multiple ways to kind of do this. I'm just going to show you one way, which the first step involves calculating your exit enterprise value by getting your last year's EBITDA times your exit multiple. Then calculating your exit equity value, which is your enterprise value minus your net debt. Then you calculate your money over invested capital, or MOIC. And this is a very common multiple that a lot of PE firms focus on. And this is your exit equity value divided by your entry equity value, which is the amount of cash you paid as a PE firm at the beginning. So again, this is like the down payment if you think about our house flipper analogy. Then you calculate your IRR by getting your MOIC to the power of 1 divided by your number of years that you projected, all minus 1. And most PE firms aim for an IRR above 15%. If it's above, usually these days, it's a clear sign that you should really go for a deal. So let's calculate the IRR in Excel for this model. So EBITDA at exit, we can get this from our projected financials, which is the 421 here. And then our exit multiple was in our assumptions, 10x. And if we multiply these two together, then we get our enterprise value. Our net debt at the end of all of this is the ending balance after the debt that we paid down. Then we subtract from our enterprise value our net debt, and this gets to our sponsor equity value. So what this means is that essentially, if you were able to execute on everything that we discussed today in terms of the revenue growth, margins, paying down debt, then the amount that the PE firm would literally earn is $3.2 billion, since all of this is in millions. And this is how much, literally, if they sold the company, what the PE firm would get transferred into their bank account, $3.2 billion. But that's not necessarily their profit, because they have, at the very beginning, put down a down payment, right? Which is the sponsor equity. So that's the 1,050 here. So I guess if you were to calculate this, what they actually profited in terms of dollar figures is 2.15 billion. Money over invested capital is simply your sponsor equity value divided by the sponsor equity at entry. So you basically got 3 times your money, right? And then if we get our MOIC, take it to the power of 1 divided by 5, since we projected by 5 years, minus 1. This gets us to 25%. And that's what our IRR is. And now you can see at the very top here, where I had for reference, our IRR pops up. And it's just helpful where to have this up here, because let's say I wanted to change some of our assumptions, make this like 10%, make this 5%, to really juice up numbers. Or you can even see, oh, what if we enter at 8 times? Then, what does everything look like? So it's helpful to have this here as reference. And now you've just completed your first LBO if you've been following along. Now, I know probably for a lot of you guys, I sped through that really quickly, and I didn't go through things like what financial terms mean and shortcuts for Excel because I've already created those types of videos. As you can see here, I have tutorials for your financial statements, for Excel shortcuts, for trading comps. I also have a DCF tutorial if you're interested in learning more about that. And so I will have this modeling tutorials playlist on my channel. So feel free to check out any of these videos. Also, wanted to give a quick plug. If you're interested in getting into investment banking, I'm creating my own course for it, working really, really hard on it. And if you sign up early, then you'll get a 50% discount. I'm also selling the resume and cover letter that got me into JP Morgan. Lastly, let's go over some advanced topics that I didn't go over in today's video. This is really brief, but a lot of times you're going to need to model out your 3 statements in order to build out your LBO. You're also going to look at different tranches of debt, which involve things like a revolver, PIK interest. Things can get a little bit complicated, so I didn't include it in this video. A lot of times you'll also build out multiple scenarios for things like your revenue growth, EBITDA margins, and pretty much anything you want to sensitize your assumptions on a bit more. And then there are a lot of credit metrics I didn't go over, and then sensitivity tables, which are important to see. Basically a range of what your IRR would be if your various assumptions change. So I didn't include these things in today's video, but I will be in the future making a more advanced LBO type video, especially if that's what you guys want. So let me know down in the comments below what you guys want more of. And also if you have any questions, because I know I really sped through a lot of things because I wanted to get through this or make this video kind of as quickly as possible because I know a lot of you guys are busy and you can always go back if you want to, if something was a little bit too fast, right? So that concludes the video. Last thing to remind you of is if you're interested in breaking into private equity, check out that Wall Street Prep/Wharton certificate program using my link down below. Use code rareliquid to get $500 off if you sign up before April 1st. And that concludes the video. Hope you guys all enjoyed and hope to catch you all in the next video. Thanks so much and peace out, guys.